Hey there, if you're looking for help with cost, volume, profit analysis, and marginal costing, you've come to the right place. My name is Steve Willis. In this video, I'll show you how to calculate contribution per unit. I'll show you how to set up a profit and loss statement under marginal costing. I'll show you how to calculate a target profit. We'll look at calculating the activity level required to reach a target profit and more. To illustrate these concepts, I will take you through 3 ACCA performance management exam questions. You can download those from the link in the description in the video. Now, if you're looking for more help on getting a pass on ACCA PM, again, check the video. I've got other solutions that can help you. Without further ado, let's get started. In our first example, let's help a business understand their break-even point in units. Break-even point is the number of units they need to sell where their costs are equal to their revenue, when their profit is at 0. We see Joe makes pizzas, so we're trying to find his break-even number of pizzas for the year. If you'd like to pause the video at this point, try it yourself. That's a great thing to do. So hit pause, and when you're ready, continue watching. Welcome back. We're going to use the principles of marginal costing to help us solve this problem. And if you're not familiar with marginal costing, I recommend you hit pause and go back to my previous video. The link is right here. It's also in the description. And I recommend you cover the principles of marginal costing before you go on. Well, we're going to need, for a break-even number of pizzas, we need the contribution per unit. So step 1 is going to be contribution per unit. And we'll find the contribution per unit. We'll find the selling price from which we subtract the variable cost per unit. The difference then is contribution per unit. Let's read the story now and let's see what information we have. So Joe has a local business making and delivering pizza. Joe charges $7 for a pizza, including delivery. So that is the selling price, $7. We can plug that right in. Now, the variable cost of making and selling and delivering a pizza, so that's all of the variable costs per unit, lumped together, that comes to $2.50. So now we get to contribution. We sell a pizza for $7, but in order to sell that pizza, we have to make it, we have to deliver it. And the unit price to do that is $2.50. So what's left over is $4.50. That's the idea of contribution. Contribution to our fixed costs, and when we've covered our fixed costs, it becomes profit. So that's contribution per unit. Now that we know contribution per unit, the rest is easy. Do we have some fixed costs? We do. Look at this. Fixed costs of the business, rent and salaries, $45,000 per year. So the next step is the break-even point. So we find the fixed costs of the business, and we learned that all of Joe's fixed costs, $45,000. And we know the contribution per unit from above is that $4.50. So the break-even point in units. Well, we have $4.50 for every unit after we cover the variable costs. So we divide one by the other, and that tells us our break-even point. 10,000 units. Team, that is how we calculate a break-even point in units. We divide the fixed costs by the contribution per unit. Moving on to our next example, we're now going to use the same principles from marginal costing to help us make a decision. We want to increase profit, and to do this, we're going to drop our selling price, and that's going to stimulate demand. Hopefully there's some elasticity of demand, so the volume will increase, and we'd like to grow our profits. So look at the question here. What volume of sales is required at a new price to increase our profit by 10%? A bit more complicated than the previous example. Let's dig into our little story, see what info we have. Well, we have the Maya company that manufactures a single product. They sell that product for $35, and the variable cost per unit, that would be the variable manufacturing cost. If there's a commission, that's a variable selling cost. The total variable cost per unit, $18.50. So we could calculate the contribution per unit. We'll do that in a moment. We've got budgeted sales of $30,000 per month, and we've got budgeted fixed costs of $250,000 per month. Now, the manager wants to grow profits by 10%. And to do this, she is evaluating dropping the price to $30, hoping that this will stimulate demand. So now we're back to that question. What volume of sales is required at the new price to grow our profit by 10%? The first step will be to find our current profit. So let's call that step 1. And we're going to use the principles that we covered in the previous video. We're going to find our sales, then we're going to get our total variable cost. Subtracting one from the other will give us our total contribution, from which we subtract our fixed costs, and then we get our profit for the period. Now, if you are fuzzy on these principles, please go back to the previous video. Link is down below in the description. I explain what all of this is about. So the current situation, we sell 30,000 units. Let's do this in thousands of units just to reduce the amount of typing that I need to do. So in 1 month, we're going to sell 30,000 units at a selling price of $35. So that's $1,050,000 in sales. My variable cost will be 30,000 multiplied by the negative 18.5. Contribution then will be equal to 1 minus the other, adding it because it's a negative number. Fixed costs, $250,000 a month. Profit then, $245,000 per month. Now that we've got step 1 done, let's go to step 2 and let's calculate how much contribution we need to achieve that 10% increase in profits. So let's call this step 2. New profit. Well, we want to grow by 10%. So the profit that we want, the target profit, will be equal to the 245 multiplied by 1.1. 270. Fixed costs are not going to change. So working backwards, we can get the total contribution that we need to earn to hit that profit of 270,000. So that's 520,000 total contribution. Now, the final step then, how many units do we need to sell to hit 520,000? Well, step 3, let's get a new contribution per unit. And if we divide the target contribution by that new contribution per unit, we will know the number of units needed to sell. So we're thinking of dropping the price to $30. Variable cost will stay the same. So the new price, the variable cost per unit, then we get a contribution per unit. So the price will be equal to $30. Contribution, variable cost will be 18.50. It didn't change. So our contribution per unit, 11.5. Now that we know the new contribution, we can go to a step 4, number of units that we need to sell to hit the 520,000. So step 4, number of units to reach desired contribution. And how will we do that? Target contribution will be equal to the 520,000. New contribution per unit is equal to the 11.5. Number of units will then be equal to 520 divided by the contribution per unit. So that would be 45.17 if we're talking about thousands. So that would be 45,170 units with a little bit of rounding. Ladies and gents, that's the solution to our second business problem using the principles of marginal costing. Moving on to our third and final example. We have a business owner thinking of making some changes to his company, and this business owner wants to understand what increase in sales will he need to earn in order to make the same profit in the next period that he made in the previous period. If you'd like to try this question on your own before we do it together, it's a great idea. You can pause the video now and continue viewing when you've completed it. Welcome back. Let's see what we have. Andre has been in business for the last 6 months selling fast food. His average contribution to sales ratio for the period was 25% on sales of $150,000. And his total fixed costs were $30,000. Before we go further, let's do a P&L for Andre, and let's understand this contribution to sales ratio business. So we have a current situation, and let's look at the situation in terms of monetary units, which we'll call dollars, and then percentage points in percentage terms. So if we use the marginal costing P&L statement that we used in the last example, and you can review that in the previous video. The link is down in the description. You remember we make a P&L, a profit and loss statement, by finding our total sales, our total variable costs. One from the other gives us our total contribution, from which we subtract our fixed costs, and we will have our profit. So we learn that our current sales are $150,000. We also learned that there was a contribution to sales ratio of 25%. So that means if we consider sales 100%, contribution would be 25%. So contribution is 25% of sales. Now, if we needed to, we could also find the variable costs, because that would be 75% of sales. We understand the fixed costs are $30,000. So we could get the profit now quite easily. So the contribution will be equal to 25% of sales, or it'll be equal to the sales multiplied by 25 over 100. Profit is then $7,500. Let's go back to the story and look at the changes that Andre is thinking of making. Well, he's considering hiring a new employee at $20,000 per year to expand the capacity of the business. And in order to increase demand for his fast food, he's going to lower the prices, which means the CS ratio will decrease to 20%. So what increase in sales is needed to keep profit at $7,500? Well, watch what we do. I'm just going to copy this over here. We'll call this proposed. And things are going to change. We want to achieve the same profit, so we can just take that from the current situation. Fixed costs are going to increase because we're going to hire the additional employee. Now here's the trick. We're only talking about 6 months. That's half of a year's salary. So half of 20,000 is 10,000. So the fixed costs will go up to 40,000. Current fixed costs plus 10,000. Okay. So now, working backwards, we can get to the contribution that we need to earn to hit the 7,500. And we know the new contribution to sales ratio will be 20%. So now we're just going to work the other way. The sales will be equal to this contribution divided by 0.2. Or if we just use ratios, it's equal to the contribution multiplied by the 100 divided by the 20. And we get 237,500 as the new sales level. But the question isn't asking us what's the new sales. We need to know the change. So now that will be the new one divided by the old one, 1.58. And if we subtract 1 from that, that will give me the percentage increase to the nearest percentage point. So a 58% increase is needed to our sales revenue if we're going to lower our prices and hire the new employee. So that's great information for Andre to have for managing the performance of his business. Ladies and gentlemen, that's a wrap on our last example and on our video. I've taken you through 3 examples. I hope you understand the principles of marginal costing and cost, volume, profit now. If you have any questions, you can leave them in the comments below. And if you found the video useful, please give it a like and feel free to subscribe. This is Steve signing out for now.